this level, and had we taken this trade in real time, we would have had a successful trade, and we'd be very happy with the outcome. But the key takeaway is that by combining as many technical analysis techniques together as is useful, the edge of our strategy improves. And improving our edge is basically in turn increasing the strategy probability. So the more technical factors that we have lining up to support a trade decision, each one of those is increasing the probability of us having a successful outcome slightly. So the more we have lining up, the greater the probability of us having a successful trade, which, as traders, is the name of the game for us. Okay, so let's move along then and look at risk management. So as I said before, this really is the most important element of any individual trade that you will place, and must be consistently performed on each and every trade. So why is it so important? Well, I think it's safe to say that all consistently profitable traders will be, first and foremost, risk managers. The reason I can confidently say that is because if they are not managing their risk appropriately on each and every trade that they place, they will not be traders for very long. Okay, so cannot overstate how important it actually is. Now, there are 4 approaches when it comes to risk management. We can avoid risk. We can only really do this by choosing not to trade. We can look to transfer risk, so we can get someone else to trade for us. But there are risks here as well, plus we will pay for that privilege. Okay, and there's still no guarantees of success. Our next option is to accept the risk, and as traders we have no real alternative other than to accept that there is risk involved in trading. There is a risk of us losing money on each and every trade that we place. However, we always look to reduce risk, so we have to accept it, but we look to reduce it as much as possible, and we do this through the use of a risk management strategy. Okay, so when it comes to risk management, there are got some rules here that are really worth you considering and putting into your trading plan. So first statement that we got to make here is that our overarching responsibility is to protect the capital in our trading account. Our trading capital is the lifeblood of our trading business. So what we do not want to be doing is hemorrhaging that lifeblood out. Okay, so we watch our trading capital in the same way as a scuba diver will watch their oxygen supply. Okay, it's that important to us. So what you can look to do is to reduce your risk on each individual trade that you place to 1% or less of your trading account. So what you do is you place a stop loss on each trade you place, and then you size your position so that if that stop loss is hit, then your loss will be equal to or less than 1% of your trading account. Okay, now what this does is allows you to sustain a number of losing trades on the bounce without doing undue damage to your trading account, or just as importantly to your own psychology. If you've sustained a number of losses and you've lost a good proportion of your trading account, that could cause a lot of people to give up. Okay, so protecting your account and your own mindset is a real great byproduct of consistent risk management, and doing this allows you to live to trade another day, because it's safe to say you never know what is going to happen on any individual trade. You can have the best looking trade set up that meets all of your rules, that looks absolutely fantastic. It can still turn around and hit your stop loss almost immediately. There are no guarantees, and this is why we always use a stop loss on each and every trade that we place. In the same way, if I get into my car, I always put my seatbelt on. Reason being, I know if I have an accident, it's going to protect me. Now, you're a lot less likely to have an accident in your car than you are to have a losing trade, because you're going to be having losing trades on a regular basis. The only question is, how is that going to affect you? If it just hits your stop and you've managed your risk, you can pretty much shrug and move on. If you have no stop loss in place and you lose all of your trading account on a single trade, then the chances are that your trading career is going to come to a fairly severe halt. Okay, so managing your risk is absolutely crucial, and it needs to be a real priority for you in terms of your trading. Alright, so also very important, key for us to consider is trade management, because anyone can enter a trade. Hopefully you'll be entering a trade because you have a setup that meets all of your strategy rules, but entering a trade really is as simple as the click of a button. But managing an open trade is going to be the real true test of your trading skill. And trade management is essentially the plan of how to get paid by the markets. And as simple as it sounds, it's not, okay? Because trade management can be a difficult aspect to master because it does affect a trader's mindset. It's going to be influenced by your emotions if you allow them to encroach on your trading. The challenge is, as a trader, is you're in a trade, it's going in your favor. A new trader is going to be very tempted to close out that trade. They're going to think, well, what if it goes against me? I've got some profit here. I should just take that profit. And that can result in traders closing out their trades too early, leaving profit on the table. Okay, again, it comes down to mindset and management and control of your emotions. But often new traders will battle against leaving money on the table, and they will be tempted to close out a trade too early, which is almost as bad as letting your losing trades run. Between them, it's bad news for your long-term trading profitability. Okay, so let's take a look at an example here. We've got a potential trade setups occurring here, and we're going to look at the detrimental effect of not using consistent trade management over the course of a few trades. So we've got two traders here, and both traders are taking the same trades on Palladium. They're taking the signals as they occur. However, they are both managing them very, very differently. So we can see our first trade setup occurs, and it's a small winning trade. Now we've got a novice trader here, has closed out, and the trade's gone in their favor, and they've made just over 0.5% in profit. Whereas the more experienced trader, who's stuck to their trading plan and managed their trade, has managed to make just under a 2% profit. Okay, so pretty big difference here in terms of the amount of money that they have made. Okay, assuming equal sized accounts. Okay, but percentage wise, certainly a big difference. So we're on to our second trade now. Setup occurs. We've pulled back to the moving averages, small bullish candle, enter the trade, and unfortunately, as can and does happen on a regular basis, this trade has gone against us. Well, our novice trader has lost just over 2% of their trading account. So either they've had their stop placed further away, or they've not sized their position accordingly, or they didn't have a stop loss in place and literally just pulled the trigger to get out of the trade when it became too painful. However they've executed the trade, they've lost just over 2%. Whereas the experienced trader, they've placed the trade in accordance with their strategy, placed their stop loss as defined by the strategy, sized their position, and then they've just let the stop loss be hit. They've taken a 1% loss. So percentage wise, they've lost half as much as the less experienced trader. On to our third trade, and this one is a good looking trade. It's a large winning trade here. So our novice trader has made a 1.2% profit, so the best trade of the three by far. However, again, they've got out far too soon. The experienced trader has stuck to the plan, and they've made a 4.3% profit. So almost 4 times as much here. So you can see just over a small sample the absolute difference that trade management can have on your overall bottom line. If we combine these, we can see our novice trader hasn't got a very good return, even though they've had 2 profitable trades and only 1 loser. They're down for the day, only slightly, but they are still down. Whereas our experienced trader has had a 5% 1% increase on their trading account, just taking the same trades. And that is why trade management is so important to your overall profitability. Okay. Alright, so let's look at some trade management considerations here. Some things for us to consider. So first thing we need to have detailed is where we are going to enter our trade, of course. Now in this strategy, we're buying when the high of this candle is broken. Okay, so the next candle or subsequent candles take out this high, we are in the trade. And we're placing our stop loss below the low of this trigger candle. So if we've entered into the trade and then we come back to the low of this candle, then the trade's not doing what we thought it was going to do. We're happy to be out of the trade at this point. So our risk on this trade is the difference between where we're entering the trade and where we have our stop loss. That is our trade risk. And the next thing we want to consider is where we're going to get out of this trade. Now, one technique that's very useful when it comes to increasing your overall profitability is scaling out of trades. And the way we do this is by closing out half of the position at 1-to-1. So let's say we've got 20 pips between our entry and our stop. When the trade moves in our favor 20 pips, we close out half of that position. That means we've locked in a profit on half of that position, which means that if the trade then goes against us after that, we're at break even, because what we have banked on half of the position would offset the loss on the other half of the position if we were stopped out. That allows us to be a lot more comfortable in terms of letting the trade run, either to hit further targets or just letting the trade run and managing it by moving up our stops. Either way, we could then look to either close out half of this position at a further target, either a 2-to-1 as we have here, or we can close it out when when we see fit, using our discretion purely by letting it run and keeping an open target. Okay. So how would we do this in practice? How would we set up our trade so that we've got multiple targets? Well, very, very simple to do. All we need to do is split our trade in two. Okay, so we open up two separate trades, and we have different targets for them. So we create two deal tickets, and let's say overall we want to risk $100 on this trade. Okay, we split that over two orders and we take $50 worth of risk on each of them. So on both of these tickets, we'll be entering at the same price. We will have our stop loss at the same level, but on one order we will be looking to get out when we have reached a 1-to-1 profit, and on the other order we will be looking to exit the trade either at 2-to-1 or whatever other target we decide to assign, or we could even leave it open if we were going to just let the trade run. Okay, so different approaches we can take, and ultimately we just need to populate the tickets, and as you can see, stop loss is in the same place, and same size trade on each ticket, and we just have different options in terms of where we're looking to get out of that trade. Okay, so let's talk about another key part of our strategy now, and that is our strategy success rate. So basically what we're looking at here are firstly our win-loss percentage. So the win-loss percentage, or WL percentage, is the success rate of the trading strategy. So let's say, for example, if we had a 40% win-loss rate, that means out of every 100 trades, 40 would be successful. If we had a 75% win-loss rate, that would mean that we could expect 75 trades out of 100 to be successful. The other thing that we need to consider is the reward to risk ratio. So reward to risk ratio is the expected dollar return for every dollar risked. So let's say, for example, if we're looking at a 2-to-1 risk to reward, we would expect on average a return of $2 for every dollar that we have risked. Okay. For example, if we had a 0.5-to-1, that means we would expect 50 cents for every dollar risked. So if we had a lower risk to reward ratio like that, then obviously we would need a higher win-loss ratio for it to be successful. If we have a higher risk to reward ratio, then you don't need the strategy to be as successful as often for it to be profitable. Okay, so let's step through an example here. So we're looking back at our previous example. We've got a strategy that we assessed over a large sample set, but in this example we're just going over 3. Okay, now again we can see that for our first trade we're getting a 1.9 percentage return, okay, on our trade. On our second trade, the loser, we are down 1%, and then for our third, our reward ratio is 4.3 to 1. Okay, so overall our win-loss ratio is 66%, so 2 out of 3 were winners, and our net gain, combining our 3 trades means that we've got a 5% or 5 to 1 risk to reward ratio based on these 3 trades. However, you need to consider you don't assess this over 3 trades. To really understand your ratios, you need a larger sample set. Now, in part 2 of this webinar series, we're going to be taking you through the rules for this strategy and explaining how we can go about trading it. So, very useful strategy to have in your tool. Okay, so let's move on then and look at our final key, and that is reproducibility. So this is the ability to trade a strategy over and over again in multiple markets over multiple time frames. Now, a lot of new traders are advised to kind of concentrate on just a single market. That's not an approach that I advocate. I like to have a trading strategy that can be applied to multiple markets and multiple time frames, and that allows you to select the very best performing markets out there at any one time, rather than maybe spending all your time looking at a market that's not performing, not delivering, and missing opportunities that you could be trading elsewhere. Now, there are 4 factors in considering whether a strategy is reproducible or not: whether it's profitable, whether it's versatile, whether it's convenient, or whether it is mindset friendly. So let's explore each of these in turn. So firstly, is it profitable? So, does it make more money than it loses over a large sample set of trades? Well, remember, every strategy will have losing trades. These are just inevitable. Now, I always think of trading, in some ways as a bit like boxing, okay? And in this way, I think the similarity lies. So, as a boxer, each and every time you get into the ring, you have to accept that you're going to be hit. Okay, sometimes you're going to be hit very hard, but boxers are conditioned to deal with this and accept this. As traders, we have to be the same. We have to be conditioned to take a losing trade. So, it's part and parcel of trading. We have to accept it. But the question is, are we making more on our winning trades than we're losing on our losing trades? And is it repeatable? Okay, so the key is to have a strategy that either has more winning trades than losing trades, so it has a high win-loss percentage, or has bigger winning trades than losing trades, i.e. a positive risk to reward. Ideally, it's going to be both. Okay. Now, these stats can either be actual, from a live strategy, from your own trading records, or you could be exploring this through backtesting if you are assessing a new strategy. Either way, it's important to understand whether this strategy is going to be profitable for you in the long run. Next thing we need to consider is versatility. So, can it be applied to a variety of markets? Well, some strategies are going to be highly selective, such as buying on the Santa Claus rally on stocks. Obviously you're not going to be doing that throughout the year. Now, if you trade a strategy that uses basic technical analysis as the basis, then it should be more versatile. that means you can apply it to more markets consistently. And the positive here is that the more a trader uses that strategy, the better they become at it. So if you're using just 2 or 3 strategies to trade the markets, and you're using them on a regular basis consistently, you're going to become very adept at trading those strategies. Whereas if you've got a wide variety of strategies that you're using on an inconsistent basis, the chances are it's going to be much harder to develop the expertise to execute that strategy in a flawless way. Okay, much better in my opinion to have a strategy that can be applied to a large number of markets, and use it on a consistent basis and become adept at using it. So our next consideration is whether it is convenient. Okay, so can it be used on an intraday or swing trade basis? Now, as per the previous point, the more frequently a trader uses their strategy, the better they become at trading it. So, my advice here, the strategies that we use and that we teach, and certainly the strategy that we're going to be covering in the next part of the program, can be used both intraday or swing, whichever you prefer. I like strategies that you can use for both. Now, I tend to trade on both intraday and swing basis. I will trade on the lower time frames, down kind of 5 minutes and below. If I'm looking at indices, if I'm trading commodities or FX, I'll be looking at 15 minutes up to 4 hours or even dailies. If you're new to trading, I'd stay on the higher time frames. Certainly, maybe look at the hourly charts and above, maybe down to the 15-minute, but no lower. The reason I say that is because the lower the time frame, the less time you have to make a trading decision. And if you're new, it can take longer to kind of run through your strategy rules, define your entry, size your position, and if you feel rushed, it's easy to make a mistake. So concentrate on the higher time frames first would be my advice, and then if you if you want to explore lower time frame trading, then feel free to do so. But you want to make sure, ideally, you've got a strategy that will allow you to take either approach to the markets and give you the flexibility to help you meet your trading goals. So our next consideration is it mindset friendly? So does it have a win-loss percentage that's greater than 50%? So does it win more often than it loses? Why is this important? Well, long periods of drawdown can be disheartening for a trader, especially if you're a new trader. And some strategies are going to have many small losing trades with the occasional big winner. This can have a detrimental effect on the trader's mindset. Now for new traders, it would be much better to use a strategy that is expected to have more winning trades than losing trades, to help ensure that you keep a balanced mindset and just give you the kind of fortitude to continue trading. Taking too many losing trades on the trot can be challenging even for an experienced trader. If you're a new trader, then it take you on a journey that you're possibly not quite ready for. So just bear that in mind. Okay, so let's talk then about next steps. So look, we've covered a lot of information on this webinar, and I hope we've given you some useful concepts to take away. Really, in terms of next steps, let's explore the follow-on webinar, part 2 of this series, which we will be teaching you a powerful trading strategy to use in liquid markets. So basically, if you are attending this webinar, and hopefully you will be, you're going to learn how to construct an effective trading strategy and tailor it to your own personal style. We will cover each aspect of this powerful strategy in great detail. So we'll give you all of the building blocks, we will give you all of the rules, and we will explain how to trade this, in the real world, out in the markets. And you get to take a look at the webinar learnings on the next generation trading platform that will be hosted by a CMC markets expert. Now, if you're not getting the results from your trading that you want, this webinar is going to be for you and is going to help you move forward with your trading. So, who should be on this webinar? Well, people who are new to trading. It's certainly going to give you some useful information to go away, a strategy that you can actually go out and trade the markets with right now. For people who are already trading but aren't happy with their returns, it's another useful strategy to add to your trading toolbox, and of course we will guide you on how best to execute it as well. People who have vast trading experience but looking to add to their trading arsenal, it's always good to consider new ideas, new techniques. You could either look to trade the strategy we teach, or you could look to take elements from it and combine it with your own strategy as well, if you are an experienced trader. So if you want to take your trading to the next level, or if you're looking to supplement your income with a new income stream, then this webinar is for you. And certainly if you're CMC Markets clients who have a funded account, then you should really look to mark this in your diary. Okay, so that pretty much brings us to the end of this webinar. Just want to thank you for taking the time to join me for the last hour. Really hope you found it useful. Hope